So far this year, foreign institutional investors have pulled a staggering 2.7 lakh crore rupees out of the Indian stock market. When ordinary investors see that kind of massive institutional sell-off, a hardwired psychological trap springs shut. Fear takes over, loss aversion kicks in, and people start dumping their own shares in a blind panic. That panic is driven by a very old assumption. If the foreign money is leaving, the Indian market must be doomed. But that assumption is completely outdated. Look at this chart tracking foreign portfolio investment in India. During the 2008 global financial crisis, right here, foreign investors pulled out around 53,000 crore rupees. That fraction of today's outflows was enough to send the Indian market plunging over 57%. But as we move across the timeline to the present day, we see outflows that dwarf 2008. Yet the modern market hasn't collapsed. It's actually holding its ground. What we are witnessing is a tug-of-war between short-term macroeconomic noise and long-term business signals. Obsessing over the daily movements of foreign capital is a trap. To survive and actually build wealth today, you have to learn how to filter out that noise and focus entirely on the intrinsic value of the businesses you own. When large foreign institutions sell Indian equities, they aren't necessarily doing it because those companies are failing. They are trading based on global macroeconomic conditions. For a foreign investor, a stock's performance is only half the equation. Their actual profit is calculated like this: total return equals the market return plus the currency return. When the US Federal Reserve raises interest rates, or the US dollar strengthens globally, the Indian rupee naturally depreciates against that dollar. Even if an Indian company performs perfectly and the stock price goes up, a weakening rupee wipes out those gains when the investor converts their money back home. The math turns negative, forcing them to pull their capital out to protect their base currency. That massive wave of selling is a direct reaction to decisions made thousands of miles away in Washington. It has absolutely nothing to do with the financial health of the companies here in India. This is why copying institutional trades is incredibly dangerous for retail investors. If you sell just because they sell, you're reacting to foreign exchange math, entirely ignoring the actual quality of the businesses. The reason those foreign withdrawals no longer crash the Indian market comes down to one massive shift: the rise of the domestic institutional investor. This chart tracks the net flows of both foreign and domestic capital in the Indian market. Look at the center, where the green line representing domestic investors consistently rises to meet and overtake the red line of foreign outflows. Following that green line to its peak reveals nearly 4 lakh crore rupees of domestic capital. That financial muscle comes directly from millions of everyday retail investors, making automatic, disciplined contributions to mutual funds every single month. Because all of that money flows in consistently, regardless of global panic, it acts as a structural shock absorber. It literally buys up what foreign institutions are forced to dump. Domestic savings now set the floor for the market. Relying on foreign outflow data to predict a crash is trying to navigate today's economy with a broken compass. Once you tune out the macroeconomic noise, you can finally focus on the signal, the actual mechanics of long-term wealth creation. As legendary investor Basant Maheshwari points out, that signal is found in high-quality businesses. You're looking for consistent earnings growth, strong competitive advantages, and a high return on equity. When foreign institutions are forced to liquidate their holdings because of currency math, they sell everything. That triggers broad market corrections, dragging down the prices of even the most exceptional companies. For a retail investor, this is the perfect setup. These artificial liquidity-driven dips offer a rare chance to acquire premium companies at a steep discount. A global currency fluctuation might slash a stock's price for a few months, but it does absolutely nothing to the actual cash flow and value of the underlying business. It is easy to get swept up in the herd mentality, reacting to sensational headlines and constantly churning your portfolio based on whatever the broader market is doing today. But wealth isn't built on daily trades. It comes from acquiring sound investments and holding them patiently across market cycles to unlock exponential growth. Trying to outsmart the global macroeconomy every week is an exhausting, anxiety-driven game. The bottom-up quality investor chooses a different path: intense research upfront, followed by disciplined patience. True financial independence means turning off the institutional noise, trusting your research, and letting time and compounding do all the heavy lifting.